The stock market crash of 2008, also known as the global financial crisis, was a severe worldwide economic crisis that originated in the United States, but had far-reaching effects across the globe. It was the most severe financial crisis since the Great Depression of the 1930s. The crash was primarily triggered by a combination of factors within the financial system, including housing bubble and subprime mortgages. In the years leading up to the crash, there was a housing bubble in the U.S., characterized by rapidly rising home prices fueled by speculative investments and risky lending practices. Many financial institutions were issuing subprime mortgages, high-risk loans to borrowers with poor credit histories, and packaging them into complex financial products called mortgage-backed securities, (MBS), and collateralized debt obligations, (DOS), and collateralized debt obligations, (GOs). Deteriorating mortgage quality. As lending standards became lax, a significant number of borrowers who were unable to afford their mortgages defaulted on their loans. This led to a sharp decline in the value of mortgage-backed securities and CDOs, which were widely held by banks, investment firms, and other financial institutions. Lehman Brothers bankruptcy. In September 2008, Lehman Brothers, a prominent investment bank heavily involved in the mortgage market, filed for bankruptcy. This event shook the financial system and eroded confidence in the stability of other financial institutions. Credit freeze and liquidity crisis. The interdependence of financial institutions meant that the bankruptcy of Lehman Brothers and the widespread losses on mortgage-related assets led to a severe credit freeze and a lack of liquidity in the financial markets. This hindered banks' ability to lend to each other and caused panic throughout the financial sector. Global impact. The crisis quickly spread to other parts of the world, as many international financial institutions were also exposed to the toxic mortgage assets. Stock markets plummeted globally, and economies entered a state of recession. To address the crisis and stabilize the financial system, governments and central banks took a series of extraordinary measures: bailouts and recapitalization. Governments provided financial support and bailouts to struggling banks and financial institutions to prevent further collapse. These measures were aimed at shoring up the capital base of these institutions and restoring confidence. Quantitative easing. Key: central banks, including the U.S. Federal Reserve, engaged in large-scale asset purchases through a strategy called quantitative easing. This involved buying government bonds and other assets to inject liquidity into the economy and lower long-term interest rates. Interest rate reduction. Central banks around the world aggressively lowered interest rates to stimulate borrowing and spending, making credit more affordable and encouraging economic activity. Regulatory reforms. Governments and international organizations implemented regulatory reforms to address the vulnerabilities that had contributed to the crisis. The Dodd-Frank Wall Street Reform and Consumer Protection Act in the U.S. was a significant piece of legislation aimed at increasing transparency, improving risk management, and preventing excessive risk taking by financial institutions. International coordination. Governments and central banks collaborated on a global scale to stabilize financial markets and prevent a deeper economic downturn. These measures eventually helped stabilize the financial system and prevent a complete collapse of the global economy. However, the aftermath of the 2008 financial crisis led to long-lasting effects, including prolonged economic slowdowns, high levels of unemployment, and changes in financial regulations to prevent similar crises from occurring in the future. I hope you enjoyed this crazy history lesson. Be sure to invest in the Patreon. Hit that subscribe button, and I will see you future Warren Buffets in the next video.